Today I'm gonna talk about dollar cost average. That is a strategy that some people use in Forex and you should never use it. Basically, dollar cost average can make sense in the stock market because let's say you buy stocks from Facebook and you buy 10 stocks for $100, and then the things go south and the market start to go down and you have more money saved, so you buy another 10 stocks at $90. So basically now you won 20 stocks. And if you think about it, the idea of dollar cost average is that when the market is going down, you keep buying, you buy here, you buy here, and then when the market go up, the stocks that you bought here start to make profit. The ones that you bought here, they are on break even, and these ones, they are negative, but since they are not so many as these ones and these ones together, if you want, you can close the trade here with the profit, or maybe you can let it go, and actually when this one is on break even, you're going to be making a lot of money from these stocks and these stocks. So this is the idea of dollar cost average, and the name dollar cost average comes from if you have 20 stocks, you bought 10 here, 10 here, what is the really cost average is $95. So it means that you have 20 stocks and the average cost is 95. So if the stock go up to 95, you are having you are losing some money here, but you are winning some money here. So you basically, by buying low, you reduce your cost, your average cost. So it means that you can really close the trade if you want here on a break even without need to back to 100 again. And that's really cool. But as I said in a previous video about trading indicators that can detect the overbought and oversold, in Forex that don't exist. I have seen euro US dollar years ago. Euro US dollar was 140. I have seen euro US dollar 1.8. Actually, if you are more than 30 years old, maybe you have seen euro US dollar 80 cents of the dollar or 90 before the euro start to get more expensive than the dollar. So what it means that Forex markets can go thousands of pips in one direction. And what's going to happen when you open one position and then you open another and then you open another, and your idea is to close on break even in the middle, and then you open another and another, you're gonna blow your account. So when you should use dollar cost average, maybe in Forex, if you have in the stock market, if you see a good company and you know that the company will not run out of business, but in Forex, never. Okay guys, if you like, please like and subscribe. See you on the next one.
Hello guys, by subscribing to Carlos Branco channel, you're gonna get 2 inches closer to your goals. And remember, 2 inches always make a difference.